Well, I had a chance to go out last weekend. It's Hongcheon province, and you can see autumn is already there. It's very nice, and I recommend you to have some time this, I believe Wednesday is another holiday, right? Wednesday, 9th. So I think mountain climbing would be a good thing to do. And my apology last week. I thought October 3rd was a regular lecture day, but it turned out to be a holiday, right? So probably you've been anxious to turn in your homework last Thursday, but we had no class. So to make it up, I'll give you a new due date, which is Thursday, 10/10. Thursday this week is a new due date for first homework, okay? Just in case, if you want to send your, turn in your homework today, it's okay. Yeah, I'll be glad to receive it. But just in case, you've been confused and a lot of excuses, that's the due date, okay? So. Okay, we will continue today the issues in measuring volatility. So far, what we've learned is to measure volatility, the standard deviation is one measure, right? That's one measure. The second, historical volatility and historical correlation, that was another, right? The second measure. And thirdly, exponential weighted moving average volatility. Okay, that's another one. Also, there is a thing called volatility index, VIX. Some people say it's a fear index because that measures market's consensus about the volatility in the stock market, like S&P 500 or KOSPI 200 for the next 22 trading days or 30 calendar days. Okay, so that was one. So these figures, information from option market, is processed to compile this one, and this is reported by Korea Exchange or Chicago Board of Option Exchange, CBOE. The one you're looking at here is a typical the volatility measure using this one. Okay. And just in case, if you are interested in looking at what is the V-KOSPI, that's the volatility index with KOSPI 200 as an underlying asset. Okay, you can check this one from krfinance.yahoo.com. So you can check this figure, okay? Just for your information. And the screen may look like this one. And we learned last time when we talk about volatility, we are looking at the number measured in annual basis, right? So annualized volatility is the common metric. So if you calculate long-term historical volatility of, let's say, KOSPI 200, that's a figure something like 20% a year. 20% a year, okay? And these numbers, sometimes it's much higher than 20%, like 40%. Right? So that was recorded around, it's 2011. I'm sorry. Was it? Yeah, I think so. Yeah, around 2011. So sometimes it gets very high, and sometimes low. The one we're looking at today is something called Garch class model. It stands for generalized autoregressive conditional heteroscedasticity. So you will see that shortly. These numbers can be calculated if you have just data. If you have data, then apply the formula and you can calculate these numbers. Okay. This is much more complicated because it's using option volatility as an input. So we don't normally calculate this one by ourselves. The exchange usually provide this figure. Okay. This one is based upon econometric model, time series model, to be exact. So we'll see this one today. But still, when we actually apply this volatility for, let's say, for risk management purpose or asset allocation purpose, sometimes more important statistic along with this volatility measure is the correlation, conditional correlation. Okay? And we know that the correlation has something to do with variance covariance matrix. The variance covariance matrix has numbers on diagonal. So those are variances of, let's say, particular asset class. Okay? So if you have stock, bond, alternative investment, and those asset classes have risk. Okay? Risk is measured by volatility or variance. Okay? And off-diagonal terms are basically covariances. Right? And correlation is simply the number that represent this covariance scaled by those standard deviations. Okay? So when you look at more than one asset or more than one series in the calculation of volatility, correlation or covariance is something that you have to calculate. But as you increase this dimension, there are many numbers to calculate, right? So a typical extension of this kind of model, which is univariate model, to multivariate framework, well, theoretically we can do it, but often it's very inconvenient. So when you increase the dimension of this problem from univariate time series model to multivariate framework, more things has to be fixed, and often it's very difficult and challenging. So you need some alternate model that allows you to calculate those numbers in more simpler way. So we'll get to that. And one of the models we'll be looking at and particularly interested in is the index model. Index could be one index or single index, or it could be multiple indexes model. But the idea is very powerful so that you can relatively easily handle those multi-dimensional problems. Okay, so we'll cover this one and this one today. Okay? So the one of the motivation behind this econometric model is, well, you can calculate those numbers that measures volatility in this way, okay? But essentially, what these numbers represent is a proxy for this one. Okay? I explained it the other day. You know, historical volatility is looking at a particular window in the past, right? And then you are moving that window to calculate this figure. And this one doing the same thing, but more distant past gets less weight, right, than the one period ago. So basically the same scheme, and it's actually calculating this thing with smaller sample. So a lot of time variation or sampling error. So the plot of these figures may look changing over time, but it's not a model, so it's very difficult to generate forecast. So what is the figure forecast? Okay. This one, although we see volatility index for today or yesterday, but these numbers are not representing volatility today. It's representing volatility, average volatility over next 22 trading days. So it's forward-looking, right? Forward-looking. So if you're actually looking at this figure today, that figure has to be compared actual volatility, average actual volatility for the next month, right? For next whole month. So this is forward-looking. But what if you want to forecast, let's say, volatility 2 months from now or 3 months from now? And it doesn't tell you that. Neither are those. Okay? So you need to build a model like the idea is very similar to building autoregressive model or ARIMA model, okay, to generate forecast. Okay. Historically, why this kind of model appears to be good? Well, you know, historically, I explained it before. If you are looking at the empirical distribution or histogram of, let's say, large capital stock return, and comparing it with a comparable normal distribution function, there is a feature like this one. We call it a leptokurtic distribution. So it's more peaked than corresponding normal distribution. I explained how you calculate this line, right? So if you have historical returns for this particular series, you calculate mean and standard deviation. Normal distribution, the functional form of it is known, right? So if you plug in those two moments, sample mean and standard deviation, to the formula for the normal distribution, you get this smooth line, right? So if actual data are generated from normal distribution, histogram should resemble this smooth line, right? But actual data shows it has thicker tail, or we call it normally fat tail, and leptokurtic is more peaked, right? This is a return from long-term government bond, and you see very similar phenomena, right? Here, it's peaked and has fat tail, right? Time series economist whose name is Boleslev, who introduced this type of model, has proven that this kind of econometric model can generate returns like the one having this kind of feature. This kind of feature. So how does it look like? Well, Boleslev is about my age. Actually, when I was a assistant professor at University of Alabama in 1990, Boleslev visited my department to give some lecture, and I learned that he has 3 kids, and I have 3 kids too. So we have we resemble each other, but he is much more famous guy in time series analysis, and a very good guy. Well, what he did is this formula. Formula looks horrible, but the idea is very simple. First, notation. We usually say something epsilon is disturbance term, right? So it has 0 mean, the variance, sigma squared, right? But our assumption is, well, it has a mean 0, but the variance is varying, time varying, okay? So that's the difference, first a starting point, right? Of course, we'll introduce this distributional assumption. In this case, normality. Okay? But the more important feature of this is, well, epsilon t is not normally distributed. Actually, the more correct way of saying it is epsilon t is conditionally normally distributed with 0 mean and conditional variance, sigma t squared. It's conditional. Conditional on what? Well, this psi is the notation indicating information set available up to t minus 1, right? T minus 1, right? So when we say information up to t minus 1 is given, is equivalent to saying, well, all those data known up to this point is available. So stock price until yesterday, bond price until yesterday, inflation rate until yesterday, all those are assumed to be known. Okay. So it's not that complicated. So if information set is given, then this model assumes that epsilon t is conditionally distributed, for example, normal distribution, or t distribution, or more general distribution like generalized error distribution, more complicated distribution than t distribution. And the limiting case of that is, of course, t distribution, and the limiting case is normal distribution. Okay. Now, last thing is there is equivalence in notation here, right? Usually we write it this way, but here we have split of this term. Right? So one is sigma t, and this one is psi t. And psi t is assumed to be unconditionally standard normal random variable. Standard normal random variable. Okay? On the other hand, sigma t is going to be determined by this one. So take a look at this formula. In this formula, sigma t squared is same as this one. Okay? All alphas are parameters to be estimated, of course, right? And all betas are also parameters to be estimated. Right? And suppose you have information about previous error term up to this leg and previous volatilities. Then given parameters, this number with this assumption is known number, right? All information up to t minus 1 is known, right? So known information, known parameters. Then this one is known at time t, right? So if psi t is standard normal, and this is known number at t, right? Because this feature, right? This structure, this is known number at t. Even though it has time subscript t, it is still known number if you specify model this way, right? So let's calculate expectation on this one. This is known number, let's say 0.20, some known number, 20%. Then, variance formula goes coming out of that formula, right? And then squared, of course. And the variance of this one is 1, right? So what is the variance of this? Conditional variance of this? Of course, conditional variance of that, which is this one. Get that? So nothing fancy. And the rest of the part is, well, let's say stock return has autoregressive structure. Okay? And what else? Well, it could have lag up to p. So p could be 0, 1, 2, up to some number p. And q is 1 up to q. But many time series or financial time series of our interest, usually P and Q are set equal to 1. You don't need many lags to model, let's say, stock return. Usually 1 is usually working very fine. So if you say Garch 1 model, generalized autoregressive conditional heteroscedasticity, long name, and if you assume P and Q are all 1s, then you can simply write it this way. Okay? So this is typical generalized Garch class model and its representation. And this is the data, right? This is the data. This is unobserved, right? Unobserved. Technically, we say this equation is referred to as mean equation. So it has something to do with the data, right? And name, natural name, variance equation, right? Before we move to the other steps, the reason why we introduced this assumption is that, well, what are the parameters of this Garch model. C is intercept term, unknown, right? To be estimated. This one, if it is AR1 and pi is also unknown, right? It could be AR2, AR3, but those are unknown, right? To be parameters to be estimated. Is this a parameter? Actually, not really, right? This is not parameter. Parameters are these guys, right? In Garch 1.1 model, 3 parameters are, in fact, parameters, right? So if you happen to estimate this one along with this, then you will have fitted value, right? Fitted value of this one. So if you have fitted value and happen to know the value in the previous period, then you can calculate recursively this number, right? So you can compute this one for each t, but not estimating cap t number of sigma t, right? So number of parameters, 1, 2, 3, say 4, 5. Garch 1.1 model, right? The mean equation specified as AR1 process. Okay. Well, how to estimate those 5 parameters? Well, actually, the way we estimate this type of model is using the method, econometric method known as maximum likelihood estimation, MLE. And maximum likelihood estimation, usually you have to make distributional assumption. Okay. So normality is one such assumption. Okay. Later we learned that, well, if you model, let's say, stock return as a Garch 1.1 process, with Garch 1.1 process, you can explain this feature. Explain this feature. But not this fat tail. But not this fat tail. So to not only this one, to explain not only this leptokurtic feature, but also this fat tail, you need to make some adjustment here from, let's say, normal distribution to t distribution, student t distribution. T distribution has fatter tail than normal distribution, right? Or some other distribution. And lastly, if you have a data generated from Garch class model, or the one that shows this type of feature in terms of empirical distribution, let me write it here. What kind of data will generate that kind of leptokurtic feature? Well, the data that's showing volatility clustering. So for instance, if volatility is small, so sigma t could be moving this way over t, okay? But if volatility increase, then the higher volatility, the period with higher volatility will last for some extended period of time. So it's clustering. So in terms of return, it will look like return moves like this one, this way, and then this way. And then when it comes down like this, return to this. Okay. So this is clustering feature. Okay. So if your data shows this type of pattern, then more likely that conditional variance is varying over time. Okay. Well, a couple of technical aspects of this model. Well, first, because Garch 1.1 is the most popular specification, the first one, it says, what is the stationarity condition for conditional variance? Well, think about this one. Can alpha 0 be negative? Theoretically. No, right? Why? Why this can't be negative? This one? But you have these numbers. You are very close to it. Probably he meant that, well, if alpha 1 and beta 1 are all 0, then it disappears, it drops out, right? So there's only one term, and the variance cannot be negative, right? So it has to be positive all the time, right? So that's theoretical constraint, okay? So if these are all 0 and this is positive, then just constant variance model, right? Constant variance model. So actually you can test it, right? What else? Well, like stationary condition in ARIMA modeling, you have to think about the case where actually, preventing this. So we don't observe this, right? Historically. So what goes up comes down, right? So to prevent that, to make this one a stationary, only condition, well, actually Volatility proved this condition in his famous paper in 1986. That is, the sum of these parameters less than 1. Very simple, right? Very simple. If you have more lags here, more lags there, the same thing. Still, sum of all alphas and sum of all betas, sum of all alphas plus sum of all betas less than 1. That's the condition. Right? Very simple one. And the second result Volatility showed in his paper is, well, sometimes it gets more volatile than other period, right? What would be the long-term volatility in this process? So what I'm saying is, what would be the average volatility? We call it baseline volatility, okay? And you can actually drive this line by computing this one. So, baseline volatility is computed as intercept divided by 1 minus sum of these two. Right? So, if these are sum to 1, what happened here? This is not defined. So less than 1, not equal to 1, right? So if sum of this is less than 1, this number is going to be positive, right? Positive. So it's going to be positive. So if you ignore this second part, Q. So if Q is 0, the P, all betas are 0, then we call it, it's not general, it's just autoregressive conditional heteroscedastic model. So the professor, whose name is Robert Engel of UC San Diego, proposed this model known as arch model in 1982. And his student, Boleslav, in 1986, added this term and provided two proofs here. And he became one of the leading econometricians. So being a PhD is not that difficult, right? Don't you think? Very simple, right? And I'll show you even simpler way of being a PhD later on. Okay. But the thing is, well, someone who invented the wheel for the first time, he gets all the credit, right? So someone who invented model up to this one, not this one, Robert Engel, he was awarded, which award? Do you remember? Nobel Prize. Nobel Prize. And Robert Engel and his colleague, whose name Granger, Professor Granger, he passed away several years ago. He looked more like Kenny Rogers, singer, with big beard, white beard. Kenny Rogers, probably you don't remember him. Okay, those two people actually awarded Nobel Prize because of the contribution in the field of volatility modeling. Okay. It's a secret. When I was actually preparing a field exam at the University of Washington in, I think it was 1987, I was taking time series analysis as a field, specialized field. I was taking exam. It was 1987, so new concepts like volatility modeling, like this one, arch, garch, or later on we learned co-integration concept of that. Those are all kind of circulated in working paper, just piece of paper, not published yet. So the thing is, I was exposed to those material, but didn't have enough time to go through every detail. But first question in my field exam was prove or derive test statistic for the presence of arch effect. So the question was proving or deriving the formula for test statistic that actually testing the presence of this kind of effect in the data here. So it's big. And also we learned from this class Kalman filter. And the second question was to derive Kalman filter. So I thought that my dissertation advisor didn't like me, and I thought that he was trying to fail me, but somehow I survived. Okay. So I mentioned this one, okay, and then a case table head forecast. Well, suppose you used maximum likelihood estimation, whatever it is. Suppose you have estimate all those estimates for parameters. And how do you calculate or forecast the volatility in next period? Can you do that? It's like calculating conditional expectation in the ARIMA model. So t plus 1, t, and all those known, right? All those are known. So you can calculate easily sigma t plus 1, right? And then t plus 1 enters here. And also, actually, what this guy is representing is this one. So you can interpret sigma t squared as conditional variance on residual squared. Same thing, right? So if you don't know what is the value at t plus 1, sigma t plus 1 squared is natural value, guess value, right? So you can recursively calculate the forecast, right? You don't have to memorize this formula, but if it just in case, if you want to calculate what would be the k-step ahead forecast, well, here's the formula. Okay. So if this one doesn't have, is required not to explode, you can see naturally that this number or this number has to be less than 1, right? Otherwise, it may explode, right? I borrowed several slides from Ender's book. Here is a white noise process, the typical, let's say, standard normal variable. Okay. And then you start from, let's say, 0. Epsilon t minus 1 is 0. Okay. Then 0. And then that one is epsilon t, right? The next period enters here, right? Non-zero epsilon, right? And then another one, right? So if you generate epsilon t using this one as underlying noise, then, this happens, right? Because volatility is varying over time, so sometimes very quiet, sometimes it could be noisy. So you can probably guess what would be the, let's say, the number observed, let's say y of t. It has autoregressive process, but having E of t defined here, right? So if you recursively generate y of t sequence, then when volatility increases, actually yt gets more volatile, right? And if it happened to be number closer to 1.0, so highly persistent series, then it gets even more volatile. So you can have some taste about what this kind of gauge type volatility is affecting the observed process for YT. Okay? Of course, you can also think of arch mean process. So what we mean by arch mean process, let's say accidentally you draw white noise process from here. Okay. So let's say it could be standard normal random variate. So having mean 0 and lying mostly within 2 to minus 2 range, right? Just you observe this one, but it's not unusual, right? It's just random, right? Random realization. Using this one, here h of t in Ender's book is same as our sigma t squared conditional variance. Okay, same thing. So sigma t squared equals to this one, just one leg, right? No leg, right? So this is arch 1 process. So conditional variance along with this white noise, then jump, right? How about this one? Well, now you're generating y. Y is simply minus 4, constant plus epsilon t. Constant plus epsilon t. But now this one is affecting in this situation. So this is what we call mean equation in previous slide. Mean equation, observed data. In a mean equation, unobserved volatility or the variance, conditional variance is accepting observed variable. So that's the name arch in mean. Right? So arch in effect. So, well, under what circumstance this kind of model could be applicable? Well, suppose that this is stock return. Stock return. And so this is the risk associated with that stock, right? When it rises, so riskier, right? Riskier. Then usually return has to rise. Otherwise, investor will not take this one, right? So if this stock is that risky, then you will raise this one, so expected return is going to be higher, right? So more investor with more less risk averse investor will take or buy that kind of stock, right? So that kind of model could be built in this framework. Of course, if you change parameters, you can generate any kind of process. Right? The thing is, you're observing just this kind of data, right? And you want to test whether there is an arch or Garch effect. What are the parameters? And whether there is a mean effect. Okay. So when you are done, then you can actually forecast it, right? So before we move, other competing univariate volatility model, let's pause here for a moment and play with real data. Have you seen this one? Well, this observation is the September 2013 Korean stock price index. Okay, so we are in an up situation, about 2000, right? 2000. Starting from 1993, it's a monthly. So if you look at this number representing particular month, what is that record exactly? Let's say October 1999. The last trading day of October, the closing price. Right? That's the monthly observation. Right? So if you actually search BOK database, there are always usually two versions of stock price, monthly stock price. The one, year-end, month-end closing. So last observation, right? The second, average observation. So all those closing stock prices for a month, particular month, is averaged, and that value is reported. That's another way of reporting it, right? But, as you can see, if you recall the random walk process is non-stationary process, the simplest one. And you can rewrite random walk process as an infinite sum of all those residuals, including the current one. Right? So let's say y of t equals to epsilon t plus epsilon t minus 1 plus epsilon t minus 2, and all the way through to the infinity. That's a random walk process, right? So during a month, today's closing, next day's closing, all the closing prices are available, right? But why these prices vary over time? Because of new information, new epsilons, right? But the last day, the last closing observation is sum of all those news, right? So current one is summarizing or containing all those information up to date, right? So that's the reason why we're picking up the last closing as a proper observation for monthly in this case. Actually, if you apply augmented Dickey-Fuller test on this series, you can say naturally that stock price is I1, or non-stationary time series. And if you further calculate autocorrelation and partial autocorrelation for this one, and you see nothing, indicating it's a random walk, right? But I remind you that when you're saying we are calculating mean and the standard deviation of KOSPI using this data, are you reporting this one as mean? Do you plan to do that? What is the mean of KOSPI in this example? Just guess, wild guess. About what? Mean of KOSPI? About this figure, right? Suppose this is a number. Well, why do you calculate mean in the first place? Why do you calculate mean? Well, the mean is a single number representing all this, right? So it has to have information, right? Is this average figure informative? Actually, not really, right? Well, if it's going to go down back to 1200, it may be informative, right? But you don't believe that, right? Hopefully not. So calculating mean of this non-stationary time series, not that informative. So even though we say this is the mean and standard deviation of KOSPI, you are not actually calculating those figures using original data, but rather you convert this one to return to make it stationary and then calculate mean. So that's average return, right? Average return is more meaningful, right? And it's standard deviation. Okay. Hopefully you remember that part. Okay, so this is the KOSPI, and of course we can go for a formal test to see if whether there is a arch or Garch type effect, but it is well known in the industry that actually there is a conditional volatility feature in this data. So we'll go ahead, estimate this one as, let's say, Garch 1-1 process. Okay. So here, quick estimate equation, and mean equation is set up in terms of stationary time series. So cos p is index, right? Non-stationary index. So to make it stationary, d log, so log difference, it's continuously compounded return. Monthly return, of course, cos p. We can specify c constant, or you can add autoregressive process, or MA, right? So suppose there is, we just try just single lag here. And then the variance, well, this is the dialog box for least square. We are not using this one. We are using maximum likelihood estimation, right? And you can see, you can find it here, arch. Okay, arch. So this one stays, right, the same. And then it says model is arch. This one, torch, means threshold autoregressive model, something else. So don't worry about it. Here, arch is setting up lag P, arch effect, original part. And this one is the lagged conditional variance part. So Q. Okay. So P, Q. And then we can try this one. This is the output. So mean equation, constant, doesn't seem to be significant. And this one, AR part, is not significant. Okay? So at 95% confidence level, this number has to be less than 0.05, less than or equal to 0.05 to be significant, right? So it's not significant, or approximately this number in absolute value has to be greater than or equal to 2, right? This is intercept term in the variance equation. Appears to be insignificant, but it's positive, right? It's positive. And this one, alpha 1, beta 1, and significant. Right? So, well, theoretically that has to be greater than 0, right? Or it has to be positive, right? But not significant, right? So, in this case, well, theoretically, it has to be strongly significant, but perhaps our data is short. So it's not measuring this one accurately. So you have to interpret this one as if this is some meaningful number, positive. Okay. And these two, and if you add these two, 0.96, about 0.96, right? So close to being 1, but less than 1. So stationarity condition is met, right? This part, adjusted R square, it is about this part. So it's not fitting data well, so it's not so big. Right? So let me try again here. Let's get rid of this AR part. You see, if you are including, let's say, pi here, AR1 coefficient, not significant. But when we talked about ARIMA modeling, we can keep some insignificant numbers, lags in your model, right? It won't hurt you. But I mentioned that you are losing sort of efficiency. So accuracy in measuring this thing. Right? So by getting rid of AR1 component here, now this is smaller, or we say it's more efficient, and this one increased. Right? Also, this number is also increased slightly. Right? So if you actually get rid of this one, then the significance may even increase more than this number, right? You see this negative adjusted R squared? Negative adjusted R squared are recorded usually when your data is simply random process. Random process. Okay. So if this is the best fitting model, then how's conditional variance look like? Your Garch graph from view, Garch graph, conditional standard deviation. This is sigma t. This is sigma t squared. Okay. We usually look at sigma t, right? Sigma as a volatility, right? So it'll look like this one. So this is the plot of sigma t for Kospi, monthly. So what's the meaning of this 0.10? Don't know much. Don't know much. You're using monthly data, right? So it's not annual figure, right? So you have to convert it to the annualized figure, right? And you learned which rule? Square root rule, right? So calculate variance first, whether this one or that one. And if your data has a frequency, let's say monthly, multiply that by square root 12, right? Okay. How to save this as a series to calculate that kind of thing? Well, you can't save this one as a number, right? So you have to do it differently. So if you look at here, proc, here, make Garch variance series. So right after estimating this Garch model, you can select proc, make Garch variance series. Then you'll ask, what should be the name for conditional variance? Sigma t squared. Default name is Garch 01 or Garch 02. Okay, let's say this one is Garch 02. Save it. And this is Garch 02, conditional variance, right? So let's say, what is SD annual? Garch 02. And this is a variance, right? So you have to take square root to make it sigma t, not sigma t squared, right? So square root function in EBUS is at SQRT. Okay. So variance is, you're taking square root of that variance times square root t. Right? So if you type this way, then SD annual. That's the annualized standard deviation. So how's standard deviation look? Well, I multiply that by 100 to express it as percent. Okay. So here is the figure. Last time I mentioned that over a long period of time, U.S. stock market, sigma was something like 15%. Right? In Korea, it's slightly over 20%. Right? So over the period, about 20%. Right? But occasionally very high, right? Very high. So when was it? That's our currency crisis period, right? 97 currency crisis period. Probably what, December or November. Probably December 1997. And then 23, 24, there is a credit card crisis, but in the stock market, it didn't show hike like this one, right? It's been going that way. So probably bond market could have been hit hard, but not the stock market. Okay. And then there's a build-up in the market, volatility, and you know what happened in 2008. So September 2008, Lehman Brothers went bankruptcy, and so this one, but the magnitude is about half of that. Right? Mainly, probably, this is due to our fault, maybe, and to the external factor, not internal one. Right? And then quickly settle down. Right? And then later here. So, do you recall in a previous slide the V Kospi, VIX using Kospi 200, and you've seen that plot volatility index. You've seen some peak, right? So that one is corresponds to this period, and you've seen this episode was around 2011, right? Correspond to that. So you can see that this is sort of a result you can interpret, right? How to forecast this volatility? Well, keep in mind this is the average, about average, right? Do you recall how to calculate that average? Where is output? Window, equation, view, output. So baseline volatility is simply this 0.000321 divided by 1 plus this 2. Right? Then that will give you sigma squared, right? Sigma squared. This figure, proxy for this one. And multiply that by square root 12 to annualize it. So you will find horizontal line. Okay? Clear? So playing with monthly and annualizing is a little tricky, but you have to do it all the time. Okay? Otherwise, you are talking very different number. People don't understand, don't agree. So because we've done this one, finding one candidate Garch model for our stock market, you can actually generate forecasts. And always you want to press this button, right? But let's see. You can actually make model and go ahead from there, right? But it doesn't say anything about make model, right? So let's press this one anyway. Forecast, right? Then, do you want to predict Kospi or the log Kospi? Let's, for fun, this is a random walk model, right? So let's take this one. My sample ends September this year, and my walk range is the end of this year, so I can generate 3 forecasts, right? So let's generate forecast from this one, and it will say forecast name cos P, there's a variable name, and F suffix. And then you can also save it, the forecast. So let's give Arch F02. That's a forecast, okay? And then forecast sample, if you just use this as whole sample period as forecast sample, then it will report in sample fit as well as out of sample fit, right? In sample, we have that already, right? By calculating this figure. So let's take a look at forecast horizon only. So this month and on, like that, okay? So this is out of sample. Sigma t plus 1 squared and 2, 3, right? And the dynamic forecast means recursively calculating this one. So this is your forecast on stock price. And this one, and because this is very difficult to read, let's take a look at this and that. Sorry, Garch forecast at the same time first. So in sample, Garch sigma t squared and this forecast the same value, right? All the way up to September this year. Same number, right? And then these three are forecast. It shows it's rising, right? Rising. So if you look at it in a graph, very difficult to see. Nothing going on, right? So let's make let's try, did I press this one and then this one? Let's reverse it, this and that. Forecast and this. Do you see? This one. So this one is in terms of monthly variance, right? So we can do the same thing. Let's say SDF as forecast, annualized Garch forecast, doing the same thing. So in terms of annual figure, this and forecast, should I pick the order the other way around? So forecast one and then this one later. Graph. And because it doesn't show much, the whole sample here, it is set as at all, right? Sample. Let's take a look at subsample. So these are period. Let's see. Graph element. So these three are forecast, right? So basically what it does is, this is a 20% line here. So probably over this sample, baseline volatility is somewhere, let's say, 25%. This way, this level. Then here on forecast, because you ended up right there, right? September. Your forecast, because arch or gauge process is basically autoregressive in nature, so it's going toward this way. Not this way, okay, this way. So long forecast is going to be average or baseline volatility, right? See the mechanism here? Okay. Seeing is one thing, but doing things is another, right? So you have to play with it, actual homework assignment, but later we'll talk about it. Okay. Let's take a look at even shorter sample. 2011. So this is the future, right? How about forecast on COSPI? Well, it says your forecast is slightly below 2000, right, in September. And it's around 2000 and a little above it, right? So that's your forecast. From this random walk process, random walk model in a mean equation with adjusted R square something negative. So it shows you, level forecast, but it could go anyway, either way, right? It could go this way or this way, whatever. Because in terms of mean equation, there is no autoregressive or moving average kind of dynamics going on. So purely random. So the movement from here to there is random, right? But if you happen to specify a random walk, then you have intercept term C that turned out to be positive, right? So it's sloped positive. If your coefficient was 0, insignificant, C is insignificant, then your forecast is this flat. Today's price is best forecast. Because we didn't use like proc, make model, and solve, so we don't have any band, right? You can't do it with this one available from Abius. So if you want to do it, you have to do it by yourself, which is very, pretty much, complicated. And also notice that because we are not simulating anything, we don't have any band here either. So prediction was because of Gauge 1-1 feature, in October it is expected to record about the same or slightly smaller volatility, and then rising, right? And continue to rise, perhaps up to some level here, right? But because this is a model, econometric model, using that model you can generate this forecast. That's different feature from these numbers. Okay? So as long as you have fit you have a model with significant fit, you can generate your forecast. But, suppose you shrink your sample from this whole sample to, let's say, a smaller one. And suppose you don't get those significant numbers. Sometimes this number, because eViews doesn't have any constraint on those parameters, sometimes this may turn out to be negative. Sometimes this may be negative. That could happen. Okay? And also may not look like this one. Okay. If that fails, then you cannot calculate this. Cannot forecast it. So that's the downside of econometric model. So what if your estimation fails? A sample gets shorter or is moving or adding new observations. Can happen, right? If you are extending this one to multivariate framework, the obtaining convergence in your estimation gets even more difficult. So knowing something is one, but being able to use it in a real application is another. Right? So when we meet next time, we will learn more alternative model to this one, or the extension in univariate framework, multivariate framework. So we'll learn the basic principle. So as long as estimation can be done every time, and that's fine. But in reality, it won't work that way. So we'll try alternate model that having similar feature, like this one, works better than alternative econometric model, but has practical applicability to find those numbers. Okay. So this is going to be a very interesting model to learn. Okay, let me pause here and see if you have any questions. Yes?
It's not an interesting question. I think there might be some mistake in the definition of conditional variance. I think the correct answer would be the conditional expectation of epsilon t square or variance of conditional variance of epsilon t.
This one?
That not t.
This one? This one is the variance. And something squared. You know, when you calculate mean has counterpart sigma. Same unit. So if you have return, having mean, say, 1%, if sigma is 0.5%, then 1 sigma variation means 1.5% change. The same scale, right? But the variance is not with this one, actually with this one, right? Squared one. So if this number is simply purely random, same as this scale, right? So conditional variance, and our notation is this one, and Anders use this notation.
So my guess is the conditional variance would be the conditional expectation of epsilon t squared at time t minus.
Sorry. I see what you mean. Thank you. Yeah, right. I use this notation to, this one, right. Expectation on this one. So, sorry about that. I was sloppy. Right? Take the variance. Right? But actual calculation is this one and expectation, right? So, thank you very much. I was sloppy. Any other question? Yeah, same thing. Notation-wise. Okay, then, well, we'll have another holiday this week, but this time it's going to be Wednesday. So if you are behind preparing your homework, please complete your homework and turn it in on Thursday this week. Okay. Okay, that's all I have to say. Thank you. Oh, midterm exam. Check your schedule. 17th. 17th is Thursday during exam week. So during this hour, so 2:30, Thursday, October 17th, is going to be our exam day. Okay. Okay, class dismissed.